Trade wars and geopolitical tensions have brought an era of increasing globalization to a close, and it's upending global trade. In 2024, for the first time ever, China's foreign direct investment recorded a net negative. After decades of constant surpluses, net FDI dropped by almost $170 billion. But that money didn't just disappear. Instead, it was diverted to alternative destinations. If not China, where did those missing billions go instead? Growing strategic competition between China and the United States has disrupted the international trade order. Multinational firms that invested heavily in China have been put in a particularly difficult position. Many have now found their futures held hostage by U.S. tariffs, great power competition, and even a potential future conflict. This has pushed many to embrace a China plus one strategy, in which they have sought to diversify away from China by finding alternative production bases in other parts of Asia. The goal is not to leave China entirely, but merely to hedge their bets, to add an alternative, a plus one, to help mitigate the risks. That means investing less in China and more in other countries. Southeast Asia, a fast-growing region of around 700 million people, is among the most attractive destinations. Over the past decade, global firms have actively shifted manufacturing and supply chains to countries like Vietnam, Malaysia, Indonesia, and Thailand in order to reduce overdependence on China. Inflows into the region rose to $236 billion in 2023, compared with an annual average of $190 billion in the years between 2020 and 2022. The Southeast Asian region has become an increasingly important global trade and manufacturing hub, but not all countries are benefiting equally. Who's seeing the most investment from the China derisking push? Today, we're counting down the biggest winners. First, a bit of background. The China plus one strategy long predates the recent geopolitical tensions. It originated in the first decade of the 2000s when China's economic boom pushed up labor costs, prompting a search for cheaper alternatives. Then came the trade war between China and the United States. In 2018, the first Trump administration slapped tariffs and export controls on hundreds of billions of dollars of Chinese goods. China responded with its own retaliatory measures, and as a result, companies exporting to the U.S. faced rising costs, giving them added incentive to diversify. Tensions between China and the European Union, including sanctions related to Xinjiang, further increased regulatory uncertainty. But nothing did more to hammer home the danger of dependence on China than the COVID-19 pandemic. Lockdowns, port closures, and Beijing's zero-COVID policy all highlighted to multinational firms just how reliant their businesses had become on China, and the associated geopolitical risks in an age of great power competition. In 2024, China recorded an historic net FDI outflow of $168 billion, the first annual deficit since data collection began in 1990. Much of this investment has flowed instead to other nations. Since the beginning of China Plus One, Southeast Asia has been a key focus for investors. Part of the reason is simple proximity. Many nations in the region remain closely connected to China-centered supply chains, allowing foreign firms to shift and adapt their operations rather than rebuilding them from scratch. And Southeast Asia is one of the only options for tapping into Chinese supply chains. So says Marco Forrester, a consultant and corporate advisor focused on Southeast Asia.
China is a massive country, has borders with, I think, 14 sovereign countries. But if you look at these borders, you have a North Korean border, not a South Korean border. You have a border with sparsely populated Far Eastern Russia and Mongolia. And then looking towards Central Asia, it doesn't seem to be a very populous area that can take on all of this China plus one manufacturing that's leaving the Middle Kingdom at the moment. So you only have South Asia and Southeast Asia left, essentially. But there's the highest mountain range in the world between China and India. And then you only have Southeast Asia left.
Plus, Southeast Asian nations were already starting to fill the low-cost manufacturing role once performed by China. Manufacturing costs in Southeast Asia's most competitive economies can be half the costs a company would see in China. As an added bonus, the ASEAN bloc has free trade agreements with a number of countries, including China, Japan, India, and South Korea, enhancing export access for goods produced in Southeast Asia. 10 of ASEAN's 11 member states are also members of the Regional Comprehensive Economic Partnership, or RCEP, the world's largest free trade pact. Eager to cash in, various Southeast Asian nations have started marketing themselves as China Plus One destinations. Some have offered incentives to attract Western business, including grants, subsidies, and tax breaks. But the benefits of the China de-risking drive have been far from even. Different nations have succeeded at attracting different kinds of investment, and at varying levels. And the de-risking has not just involved global multinationals either. Chinese companies have moved manufacturing to Southeast Asia too. In some cases, this is to avoid U.S. tariffs and export controls. In others, they have used the region as a low-cost manufacturing annex. But who is actually winning the China de-risking race in Southeast Asia? Here is our ranking of the 5 greatest beneficiaries of the China de-risking shift. Number 5 is Indonesia. For multinationals looking to reduce their reliance on China, Indonesia has been one of the most attractive options. It boasts an enormous labor pool and a vast wealth of natural resources. In contrast to a rapidly aging China, Indonesia's demographics skew young. The country's median age is 29, and 60% of the population is under the age of 40. Over the past decade, Indonesian exports have grown rapidly, and the country has seen a considerable amount of relocated manufacturing investment. Indonesia's exports shot up from $180 billion in 2019 to $290 billion in 2023. That's the highest rate of export growth in all of Southeast Asia. During the same period, Indonesia's share of Southeast Asian exports to Greater China rose from 12 to 20%. Its share of the region's exports to the rest of Asia increased from 18 to 22%. In 2023, Indonesia received about $33 billion in greenfield manufacturing FDI. However, a lot of Indonesia's export growth has resulted from Chinese investments in commodities such as metals, minerals, and chemicals, and the development of downstream industries connected to those commodities. These firms are responding less to China Plus One incentives than to Indonesia's industrial downstreaming policy. Indonesia's government placed restrictions on the export of raw materials like nickel in order to encourage investment in local processing facilities and the development of an EV battery supply chain.
Indonesia is the giant of Southeast Asia. Indonesia's economy is more than that of Vietnam's, Malaysia's, and Singapore's combined. It has over 270 million people. Many companies, many of our clients go into Indonesia for Indonesia, and that is not considered China Plus One. That can be linked, however, because we see more and more Chinese companies expanding overseas for the first time in their whole corporate life cycle, that can be linked to limits of growth within the mainland Chinese market, where companies are forced for the first time to expand overseas to secure a growing market share.
Still, Indonesia faces a lot of structural obstacles to attracting more investment. Skills remain low by regional standards, which hampers the country's ability to attract high-value investments. It is also burdened with complicated regulations and a lack of infrastructure. In the World Bank's Ease of Doing Business ranking for 2025, Indonesia ranked 73rd out of 190 countries, well below all of ASEAN's other developed economies, aside from the Philippines. While the government has made improving the business environment a priority, President Prabowo Subianto's unpredictable economic policymaking has unsettled investors and raised questions about the country's trajectory. While the country is currently lagging behind its potential, it does have the ingredients to be a main beneficiary of the China Plus One trend over the long haul. Next in line is Thailand. Thailand's exports have grown from $257 billion in 2019 to $314 billion in 2023. While this is modest by regional standards, the country boasts an established industrial infrastructure and is already well integrated into global automotive and electronics supply chains. As such, it has been well placed to attract advanced manufacturing firms seeking diversification away from China. Thailand is also investor-friendly, ranking 21st in the World Bank's Ease of Doing Business Index. In 2024, Thailand's Board of Investment reported that investment applications had reached a 10-year high. Interests spanned from Thailand's digital infrastructure and advanced electronics to the EV value chain. In fact, Thailand has now become the key Southeast Asian destination for EV production, supported by government incentives and a growing market demand. However, Thailand's ceiling may not be as high as some of its peers. Despite the influx of investment, average manufacturing wages have remained flat. This compares to its neighbor Malaysia, where increased China Plus One investment has driven considerable wage growth for skilled workers. Meanwhile, skills mismatches and a rapidly aging population restrict the type of investments Thailand can attract. with more than half its workforce in the informal sector and a continued reliance on low-skilled services. The nation's upskilling efforts face formidable obstacles. Its logistics infrastructure ranks only 34th globally, according to the World Bank's 2023 Logistics Performance Index. All of this suggests that Thailand may succeed in pulling investment away from China, but may struggle to rise up the value chain.
I believe that we will receive more China Plus One investment in Thailand with increasing infrastructure build out, especially when we look at a rail through Laos that's connecting directly to Bangkok and also Malaysia and Singapore in the future. I would think that there would be more manufacturing there. Thailand has been receiving more of a higher end manufacturing that's coming out of China. I believe that the current demographic crisis in Thailand will be an impediment to Thailand's economic success, especially when it comes to manufacturing, because we are not at the automation stage in Thailand where we want to be.
In third place is Singapore. The Lion City has long served as a regional trade hub and preferred regional headquarters of multinational corporations. As such, it has benefited considerably from the shift of production and investment to Southeast Asia. Multinationals moving supply chains to countries like Vietnam, Malaysia, or Indonesia often relocate their management and supply chain control centers to Singapore. This has resulted in considerable job growth in areas like finance and legal services. The reason is obvious. The World Bank ranks Singapore as the easiest place to do business in Asia. Similarly, Singapore benefited from the Chinese crackdown in Hong Kong in 2019. As the CCP exerts more and more control over Hong Kong, significant numbers of global and even Chinese firms are looking to relocate their Asian headquarters to Singapore. While Singapore has benefited in this way, it hasn't attracted many China Plus One investments of its own. Part of the reason is that the cost of manufacturing in Singapore has made it unfeasible for all but the most advanced types of products. Instead, Singapore has mostly benefited indirectly from the derisking trend, capitalizing on its reputation as a premier regional business and logistics hub. Going forward, the city-state is ideally positioned to facilitate the seamless flow of goods, capital, data, and services between China and the newly established Plus One locations elsewhere in Southeast Asia, and to benefit accordingly.
So Singapore, for I would say 90% of our clients, still is the quote-unquote control tower, the regional headquarter. Companies that want to leave China and want to enter Vietnam and Indonesia and Thailand, they would often open a holding company in Singapore first just to make things easier. Singapore is still interesting for high-end manufacturing. Very deep tech R&D in semiconductors or biomedical components, aerospace components. That's where Singapore is still quite interesting for manufacturing itself. World-class logistics, of course, financial and digital infrastructure. But then you have the sky-high operational costs, which explains that you cannot do really much else in Singapore other than the top ends of the value chain.
In second place is Malaysia, which has been able to build on decades of experience in electrical and electronics manufacturing to score China Plus One investments. While the country has attracted a range of foreign investments, these have been dominated by one particularly important commodity: semiconductors. In the age of AI, integrated circuits have become a central subject of competition between China and the United States. Washington, in particular, has introduced a range of export controls to prevent China from accessing the most advanced chip technology. This has also prompted chip firms to diversify their supply chains and reduce their dependence on China. Malaysia is among the most attractive options, having been involved in the manufacturing of integrated circuits since the 1960s, particularly in assembly, testing, and packaging, the final stage in the chip manufacturing process. Malaysia has other advantages too. The country boasts a skilled English-speaking workforce. It has well-developed infrastructure and a business-friendly government, which the World Bank ranks 12th in the world in terms of ease of doing business. The country also benefits from its strategic geographical position as a shipping and logistics hub. Perhaps Malaysia's biggest asset is its reputation for neutrality. In making his pitch to foreign investors, Prime Minister Anwar Ibrahim has focused not just on Malaysia's experience in electronics manufacturing, but also its geopolitical position as a neutral and non-aligned location.
Malaysia, just after Singapore, is hailed as the country where it's easiest to do business in Southeast Asia. It's just much more transparent. There's an English-speaking workforce. The HDI is very high, the Human Development Index. The education level is high. Malaysia is a country that attracts foreign labor, foreign engineers. also from the region. On top of that, Malaysia has cheap and stable energy. So Malaysia has benefited from a lot of tech investment, not just in circuit and chip manufacturing, but also in data centers. So all of this plays into Malaysia's recent success.
And that brings us to the biggest winner from China Plus One, Vietnam. The country saw an immediate impact from U.S. President Donald Trump's trade war with China. Vietnamese exports to the U.S. increased from $49.1 billion in 2018 to $66.5 billion in 2019 and continued rising from there. Its exports to the U.S. currently sit at more than $193 billion. The country's competitive labor costs, proximity to China, and expanded industrial infrastructure have all made it an attractive alternative destination. Northern Vietnam's close proximity to the Chinese border allows companies to maintain supplier relationships in China while shifting part of their production to Vietnam. The country also offers cost efficiency relative to developed manufacturing hubs, with labor costs trailing those in Thailand and Malaysia. On top of this, the country boasts a strong network of free trade agreements, which enhance Vietnam's export access and supply chain integration. In addition to the ASEAN agreements, it has bilateral trade pacts with countries including Japan, South Korea, the European Union, and the United Kingdom. Vietnam is also a member of the CPTPP, a massive free trade agreement spanning both sides of the Pacific. With a China Plus One framework, Vietnam's trade architecture allows companies to diversify production while maintaining preferential access to major export markets.
We can clearly see Vietnam as the biggest benefactor of shifting supply chains. Again, that has to do with geography. When you have an existing supply chain in southern China, you can connect the supply chain with a factory in northern Vietnam via truck, via a land border within 12 hours, which is a massive opportunity. But that also comes with risks, of course, such as transshipment allegations and fake made in Vietnam labels and tariff exposure with a growing trade surplus with the US, of course.
One challenge for Vietnam is that it has also witnessed a huge shift of Chinese production to the country, particularly in the north. This has given rise to US suspicions that Chinese firms are using the country to launder Chinese exports to the US and avoid American tariffs. The issue of fraudulent transshipment remains a key sticking point in the US-Vietnam trade relationship, and if left unresolved, could potentially result in punitive US tariffs that could reduce Vietnam's appeal as a China alternative. Whatever happens in the coming years, derisking is here to stay. In a tenser and less predictable world, global firms will continue diversifying their operations and hedging their bets. Southeast Asia's governments will no doubt continue to compete to attract this investment and ensure that they become and remain global firms' preferred plus one. One of the biggest focus areas for de-risking away from China is in the critical field of semiconductors, or integrated circuits. Here, too, Southeast Asian countries are major players, but there are clear frontrunners. Check out our video on Southeast Asia's chip champions for more.